What's up investors, we need to talk about Redbox. The stock, RDBX on the Nasdaq that is getting a lot of attention now after gaining 40% on Friday. If you hold shares of Redbox, then you need to see this video. There is an unbelievable amount of lies out there right now about this stock. I called this stock at $3 a few weeks ago just before it ran to over $10, and I see a lot of shocking comments and posts now that it will make a huge run again. You can never underestimate the possibility of a meme stock short squeeze and retail investor interest. We've seen it with the likes of Mullen Automotive recently, as well as Metamaterials, DWAC, and with the likes of GME and AMC stock. But the risk here is bigger than any of these, and in this video I will explain how that is. If you have bought RDBX stock, then you need to listen to this. So if you find any value in this video, help me grow this channel by smashing the like button and dropping a comment. I'm aiming for 300 likes on this video, help me make that happen. Subscribe to the channel if you're new and hit the bell notification so you never miss a video that could provide you with critical information. I want to point out that I'm not a financial advisor and this is not financial advice. Now let's get into it. So who are Redbox? For anyone that is unfamiliar with Redbox as a company, Redbox is known for their bright red DVD rental kiosks that tend to be placed in busy retail locations to offer a selection of DVDs that can be rented for a few dollars. The company also operates a growing digital stream service that provides paid movies from Hollywood studios and hundreds of content partners, as well as over 130 channels of free ad-supported streaming television. Redbox was founded 20 years ago and was once the low-cost competition to video rental stores like Blockbuster, adding thousands of new kiosks each year. But now Redbox finds itself on the other side of innovation, replaced by streaming services and on-demand digital rental. After growing rapidly for several years, Redbox slowly seen its market decline as the likes of Netflix or Amazon Prime started to grow rapidly. But Redbox does still have about 40,000 kiosks throughout the United States. In fact, when we look at the investors' presentation, they estimate that 90% of all Americans are within a 5-minute drive of a kiosk, which does provide huge exposure that the company can take advantage of. But it appears that the main focus for Redbox right now is the shift from video rentals through their kiosks over to subscription video on demand. By converting a small percentage of existing customers to consistent multi-product users, could lead to 800 million to over 1 billion in annual revenues. So since my last video, there has been huge news for Redbox, and I will take a quick look at this before moving on to what is more relevant. Chicken Soup for the Soul Entertainment has agreed to acquire Redbox. The combination of Chicken Soup and Redbox will create a leading independent direct-to-consumer media platform. The combined company will have increased sales across content production and distribution, with a massive content library, more than 38,000 kiosks nationwide, extensive digital capabilities, and access to millions of targeted customers, including nearly 40 million Redbox Perks members. So on the face of it, this looks like there is huge synergies between the companies, and Chicken Soup is in a way acquiring an expanded customer base more than anything else. The company expects to deliver annual run rate cost synergies in excess of $40 million in 2023. Chicken Soup expects that the combined company will exit 2022 with a run rate exceeding $500 million of revenue and between 100 and 150 million in adjusted EBITDA. So those projections look pretty good on paper, but let's not forget that not long ago, Redbox was also projecting fantastic numbers in their investors presentation when they were becoming a publicly listed company. Redbox stockholders will receive a fixed exchange ratio of 0.087 of a share of Class A common stock of Chicken Soup per Redbox share. So first of all, let's think about this from a logical point of view. For every Redbox share, Redbox shareholders will receive 0.087 of shares of Chicken Soup. So that means that shareholders will get 1 share of CSSE stock for every 11.5 shares of RDBX stock. RDBX stock is currently $5.32, so 11.5 shares of Redbox has a value of just over $61, and in return, shareholders will receive 1 CSSE share for this. CSSE stock is trading at $6.27, so this does not make sense at all for Redbox shareholders, but it actually gets far worse than this. Before we go any further, before you get the urge to start calling me some paid basher or accusing me of shorting the stock, before you jump to conclusions and decide to either get abusive or tell me I have no idea what I'm talking about, let me remind you that only a few weeks ago, I was posting videos and tweeting about the opportunity here, back when the stock was only $3. So clearly I'm not a paid basher. I call it like I see it. By the way, this is not financial advice and everyone should be doing their own due diligence. But stick around and I will discuss far more of the overall story here in just a moment. Following the close of the transaction, Chicken Soup for the Soul, stockholders will own approximately 76.5% of the combined company and Redbox shareholders will own approximately 23.5% on a fully diluted basis. The transaction is expected to close in the second half of 2022, subject to the usual required regulatory approvals, and the combined company will trade under CSSE on Nasdaq. So if this deal is so bad for shareholders, then why is the stock going up and why would management even consider agreeing to these terms? Now this is something that I spoke about in my previous video and I will look at the financials in just a minute, but as it says here, the risk of bankruptcy over the next 12 months is very high and investors should be concerned. Now I feel this is somewhat of an understatement of the risk of bankruptcy. This risk was not high, it was pretty much a certainty. And that much was discussed in the going concern disclosure made by management in their recent annual report. So let's look at the Redbox report to see exactly why management would agree to such a deal for shareholders. This should help everyone to understand the risks involved here, the position that the company is in, and how the stock has ended up being so heavily shorted in the first place. And this stock is heavily shorted, which in a way has provided its own opportunity too, which I will talk about in a moment. Looking at the company's balance sheet, we can see that they have total assets of $378 million and total liabilities of $440 million. This means that Redbox is in negative equity to the value of $62 million. To make matters worse, long-term debt is by far the largest liability, while goodwill is recorded as the biggest asset. Now, if you follow this channel, you will know that I hate to see goodwill. Goodwill is not a real asset. This $147 million could simply be written down as an impairment in the very next earnings report. To put this simply, this is a terrible balance sheet. Current liabilities are also 2 times current assets, and the fact that they have only $18 million in cash is very worrying for RDBX stock. This coupled with the fact that revenues have been dropping dramatically year over year, down 66% from $800 million in 2019 down to $280 million in 2021. This is made even worse because costs have not even halved. What was once a profitable business is now a huge loss maker. Losses of over $140 million for 2021. So this raises a huge going concern issue for this company. And we can see here in the notes to the accounts just how bad things really are. In January, Redbox borrowed the remaining availability under its revolving credit facility, and on the 1st of April 2022, the company announced a reduction in force of 150 employees, and management have highlighted the level of the problems that they are facing. There is substantial doubt about our ability to continue as a going concern, and this could materially impact our ability to obtain capital financing and the value of our common stock. If we cannot continue as a going concern, our stockholders would most likely lose all or most of their investment in us. So in a way, this deal does make sense for Redbox, but how does it make sense for Chicken Soup? They are essentially absorbing a high debt load in what feels like a massive user acquisition deal. There is a link to this article in the description for anyone who wants to have a read of this, but I will just point out a few things quickly. Among the concerns that are evident from Redbox revenue trend over the past 3 years, maybe the biggest one is the digital revenue is actually down in 2021 compared to 2020. Despite growth in this segment since 2019, the company is still almost entirely reliant on physical DVD rentals for revenue. The main selling point for the physical kiosk-based model is that the DVD format rentals provided by Redbox are $2 per rental, while digital streaming rentals of movies are often 3 times that from a consumer cost perspective. So for me, this does not make a whole lot of sense. Chicken Soup is also acquiring Redbox with common shares. So existing CSSE shareholders get the double gut punch. for a larger debt burden coupled with quite a bit of share dilution at the same time. Best case scenario, Redbox can once again take advantage of DVD movie release schedules to offer a complimentary low-cost movie option, or at worst, this was a very large and expensive user acquisition deal. Looking at the Chicken Soup financial statements, we can see that they have total assets of 270 million along with total liabilities of 196 million, giving Chicken Soup a total equity figure of $74 million. Given that their market cap is only 92 million, this is not bad. But once again, we see a goodwill figure here of 44.9 million. And given the fact that Redbox already has negative equity of over 100 million, the combined company will not have good consolidated financials. Chicken Soup have net revenue for the first quarter of the year of $29 million, but have operating losses of over 17 million for the latest quarter. Losses for the full year 2021 were in excess of 50 million. As I mentioned already, the hopes of management are that cost synergies between these companies can deliver in excess of $40 million, but I am very skeptical of this. I do not think that this is a good deal for any of the parties involved, especially RDBX shareholders. But a lot of people across social, like StockTwits and Reddits, are clinging to the hope of a GME style squeeze, and given the conversion rate for RDBX stock into CSSE stock is about 11.5 shares for one new share, then this is valuing RDBX stock at about 55 cents per share. In conclusion, I find the stock way too risky. I think it's insane. If you were looking at Redbox stock as a squeeze play and you want to gamble, then fair enough, it's your money, it's your choice. This is not financial advice, just be aware of the risks and the real value of these shares. In my opinion, even if this does spike up, it will fall down and it will go far, far below its current price. If you are looking at the combined company for the long term, again, do your own research, but CSSE stock looks like a far better choice than RDBX if you actually believe in this business going forward. So guys, what do you think? Will you be gambling on this stock either in the short squeeze or for the long term potential? Drop a comment and let me know what you think of this company and if you enjoyed my video. I would greatly appreciate if you could smash the like button and hit the subscribe button if you're new to the channel. Follow me on Twitter and I'll catch you in the next update.